Hello, Mark Ostwald from ADM ISI, and a few thoughts on where we are with financial markets at the moment. I think the interesting aspect of everything at the moment is how we have a strong dollar, and yet the risk asset rally doesn't seem to be wanting to relent. And yet this time last year, the strong dollar was actually a signal moment for a big meltdown in emerging market assets, and it wasn't particularly good for the equity markets either in the longer run. So where are we? We are, first of all, poking through new highs in terms of the US dollar rally. And that should be a warning sign, I think, for everybody, that we are in a situation where, first of all, the dollar rally is not necessarily a function of interest rate differentials as it was last year, where we were looking at a situation where the Fed was going to continue to raise interest rates, and the Eurozone and the Bank of Japan were basically looking at situations where interest rates were likely to remain flat at best. Now we're in a situation where it looks like we've got a bit of a dollar shortage going on. And therefore, what we should be worrying about, above all, is what's going to be happening with emerging markets and indeed with the euro area and Japan. So if we go to the next chart, the US 10-year yield is also not really quite in sync with all of this. Yes, we have recovered from the sub-240 levels that we reached in late March, which was partly predicated by the end of quarter story. But we are still at 252, and yet we are in a situation where we're looking at US financial data, economic data, and saying, well, we were quite gloomy about everything, but we've got US Q1 GDP coming up in the not too distant future, and it's likely to be above 2%. Why are we down at these sort of levels? To be sure, the Fed has signaled that it's on a pause, and markets are assuming the next move in rates is going to be down. However, that doesn't necessarily mean that's the correct view, and the Fed is not going to lean against anything at the moment, because it really does want to wait and see how things are going to pan out through the rest of the year. Which leaves us in a very, very uncomfortable situation when we look at the next chart. And the next chart is about the 5-year break-even inflation rate, which we can see is basically at 186, when actual inflation is around about 210. Meanwhile, the US gasoline price continues to rise, which basically signals to everybody that we're going to see an upturn in inflation, above all driven by petrol prices. And the two things have not been quite this far apart in a very, very long time. Therefore, one or other is wrong. I would bet my bottom dollar that the gasoline price is not wrong, but the US break-even inflation rate is. And if the US break-even inflation rate is wrong, then we basically need to take US 10-year yields and indeed TIPS inflation break-even rates up to a much higher level. And we also need to assume that the Fed's next move in interest rates is going to be up rather than down. And that is basically the problem that we've got at the current point in time.